let's dig a little bit deeper, and this gets into a sometimes contentious issue amongst Austrian economists. But I take it that you are from the Rothbard school as a critic of fractional reserve banking, and particularly how this plays into all of this fraudulent banking that we're seeing right now. Explain what fractional reserve banking is and what the Rothbard critique of that is.
So fractional reserve banking is when you deposit your money, and even though you may be under the impression that your money is sitting there like it's a warehouse, or like a farmer taking their grain to a grain silo, right? You might think that your money is sitting there, but actually it's almost immediately lent out. Probably before you exit the bank door, it's gone. And it's lent in loans, or it's sent out in speculation on financial markets, or there's a million things that banks can think to do with your money, but very rarely does it actually sit there and wait for you. And this is a practice that it's really created the financial panics that ultimately led to the Federal Reserve, is banks irresponsibly sort of double promising the money, right? So on the one hand, they lend it out, and then on the other hand, they tell the depositors, oh yeah, you can come by anytime you want. And so my argument is that, this is fraud because they are telling two people that they have the same dollar, right? So it's fundamentally no different than what Sam Bankman-Fried said, where with FTX, where people gave him money and he said, oh, yeah, your money is right here for safekeeping, right here in my pocket. And then, he went out and spent it on, real estate in Bahamas. And what was the pod he had? Anyway, his love family and, whatever their needs were. And so the alternative is, in my opinion, that you essentially you structure banking the way that you would structure any other corporation, which is that if the bank claims to have money that you can immediately withdraw, which is called a demand deposit, or most of us would know it as a checking deposit, that actually has to be in cash, not in bonds, alas, not in gold either, because it has to match what the person's taking out. Gold does fluctuate. So demand deposits have to be backed by cash. And then the bank is also free to offer time deposits. So most Americans know this as a CD, a certificate of deposit. In the case of a CD, those are typically for terms. So it might be 3 months, 1 year, whatever. The bank can freely lend those out. And in fact, it doesn't have to back it with anything. And the structure looks like, say, Ford Motor, right? So Ford Motor has certain things that it owes right now. Okay, it owes a vendor, who delivered Chick-fil-A delivered lunch, and he's waiting for the money. Okay, so it has some money that it owes right this moment. Ford also has other chunks of money that it's going to owe in 10 years, so like a bond. And Ford is not required to set aside a bunch of money for that 10-year bond. Okay, and so I think the full reserve, Rothbard's solution for this instability, this sort of $2 being or $1 being in two places at once, is to have that clear divide. So empirically, about 20% of the money in the U.S. banking system is in checking deposits. The rest is in saving deposits. If that percentage mirrors, then the typical person would have walking around money, let's say 1 month spending or 2 months, whatever. They would have that in their checking account. That would be actually backed by cash. The rest of it would be in long-term accounts that banks would offer you attractive interest rates for in order to entice you to then allow them to relend it. That would be a completely stable banking system. It would mean that if you had a bank run, that would simply be people withdrawing their cash. Your bank would shrink. You might hope that doesn't happen. You might have an uncomfortable talk at the shareholders meeting, but your bank is not in failure of collapse because you do not owe money that you pretend to have.